You're staring at a massive, intimidating lump sum of debt on your company's balance sheet under trade payables, but you have absolutely no idea exactly who you owe.
Right, it's just a terrifying number.
Yeah, and you don't know how much they specifically need or, when they might just cut off your critical supplies.
Which is a nightmare scenario for literally any business.
It really is. Whether you're a 23-year-old on your morning commute dreading your next ledger task, or a 38-year-old professional on your lunch break terrified of losing a key vendor, that exact blind spot destroys crucial business relationships.
And if you are currently studying, it absolutely ruins exam scores.
Completely. But there is one simple, everyday document that instantly solves the puzzle. Welcome to the deep dive for our global audience. Today, we are covering supplier statement reconciliations for the FA1, FA2, and FFA exams.
It's a core topic for sure.
Yeah, so we will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
I love that structure because it's a process that, well, it sounds incredibly technical on paper.
Oh, the terminology is brutal.
It is. But once we strip away the jargon, it's really just a matter of matching 2 sides of the same story.
So let's actually solve that blind spot we just talked about right away. At its core, a supplier statement reconciliation is just the process of comparing your internal accounting records for an individual supplier against the actual statement that the supplier sends you.
Basically, you take your numbers and you hold them up against their numbers to see if they match.
Exactly. I like to think of it like checking a personal spending app against your monthly bank statement. You're just scanning through it to ensure you haven't missed a sneaky subscription fee or, been double charged for a coffee.
Yeah, that's a perfect analogy. And that verification process, matching your internal tracking against external reality, is necessary because of a really surprising fact about how accounting systems are actually built.
Oh, right, the general ledger thing.
Yes. The general ledger trade payables account, the one sitting right there on the balance sheet, is practically useless for daily operations.
Which sounds totally wild to anyone who just spent, weeks learning how to build a balance sheet. I mean, the trade payables figure is treated like this ultimate source of truth, right?
It is treated that way, yeah. But it's really just a rolled-up summary. It provides a snapshot of total debt.
So it might tell a board of directors that the company owes, say, $5 million across all its vendors.
Exactly. But it offers absolutely zero help to the accounts payable clerk who's trying to determine what is owed to one specific paper supplier.
Because you can't just write a check to trade payables. You have to pay individual human beings and companies.
Right. Reconciling individual accounts is simply a verification tool to match your math against the supplier's math.
So, keeping that reality in mind, if we look at the broader business implications, why is this considered so critical? Accurate records are really the only way to preserve good vendor relationships?
Oh, absolutely. If a company has a history of non-payment or messy records, suppliers will just pull those favorable credit terms.
Yeah, they'll demand cash up front, or they'll just stop shipping goods altogether, which shuts down your business.
But on the flip side, keeping pristine records and paying on time unlocks all kinds of preferential treatment. You get trade discounts, you get longer windows to pay.
And that operational reality translates directly into why examiners test this topic so heavily. There are 2 main reasons examiners love this. Here's the first one.
Right, they want to see if you can identify timing differences, like a payment that is in the mail.
Okay, so just normal friction in the system.
Exactly. And the second reason is that it tests your precision in spotting actual accounting errors.
Like allocating an invoice to the wrong supplier entirely.
Yep. Or typing in the wrong amount. They are testing if you can catch a mistake made by a human being or a software glitch.
So it's basically financial detective work, but instead of solving a major crime, you're just trying to figure out who fat-fingered the calculator?
That is literally it. You are hunting for the fingerprints of administrative friction.
Okay, so to actually act as that financial detective, we need to understand the mechanics of the process. There are 3 parts to this. Let's take them one at a time.
Sounds good.
So part 1 is the individual supplier account. Since the general ledger just gives us that useless lump sum, entities have to maintain separate, highly detailed subsidiary ledgers for every single vendor.
Right, because otherwise you miss payment deadlines or just completely forget about purchase invoices.
Simply put, it tracks exactly who you owe.
Which is the internal side of things.
Right.
But part 2 is the external side, the supplier statement itself.
Right, the document they actually send us.
Exactly. It covers a specific period, usually a month, and it shows the starting balance, all the new invoices they've issued, any credit or debit notes, the payments they've registered from us, and the final ending balance.
But what happens when their statement says you owe $750 and your own system says you only owe $650?
Well, that friction brings us to part 3, the discrepancies. When those two documents are laid side by side, you have to figure out why they disagree.
And those differences usually fall into a few predictable buckets, don't they?
Yeah, it could be an early payment discount that wasn't accounted for, or it could be a missing debit or credit note.
Or just simple transposition errors when entering invoice data.
Exactly, typing a 6 instead of a 9.
So to bring that together, a supplier statement reconciliation takes your individual record, compares it to the supplier's document, and isolates the specific timing gaps or errors causing them to disagree.
That's a perfect synthesis.
So let's see those discrepancies actually play out in a concrete global business scenario. Let's walk through the example from our sources with Murag and Halima.
Okay, so Murag is the customer, and she's reviewing her records against a statement she received from Halima, her supplier, on March 7th.
And right away, Murag's records show a completely different balance than Halima's statement.
Right. So Murag goes line by line, and she spots a massive discrepancy regarding one specific purchase invoice referenced as in V105.
Okay, let's break this down. Because Murag's system shows that she owes $174 for this invoice. But Halima's statement shows Murag owes $498.
It's a huge gap. And the context here is that all purchases between them are subject to a 20% sales tax.
Okay, wait, let me actually do the math here because this is where the exam scenarios get super tricky. So Murag realizes she made a transposition error. She accidentally entered a net purchase of $145 into her system.
Right, she typed 145.
Okay, so 20% of 145 is $29.
Yep.
So if you add the 145 and the 29, you get $174.
Exactly. That's how her system generated that wrong total.
Yeah.
But she flipped the numbers. The actual net purchase was $415.
Oh, wow. 145 instead of 415. That is such an easy mistake to make when you're just staring at spreadsheets all day.
And her accounting software just blindly calculated the 20% tax based on that typo. But Halima's system had it right.
Okay, let's run Halima's numbers. Net purchase of $415, 20% tax on that is $83.
Right.
Add those up, and you get a gross total of $498, which matches the statement perfectly.
Exactly. Now, as Murag keeps checking, there's another transaction. A credit note referenced CN1-116.
Wait, I noticed that in the source material, that credit note only covers half the original invoice amount. Doesn't a credit note have to cancel out the full invoice?
Oh, no, not at all. That's a common misconception. It might just be a partial return for a damaged batch of goods.
Oh, so if half the shipment arrives broken, you only get credit for that broken half.
Exactly. You never delete the original invoice. You just enter the partial credit note to adjust the final balance.
That makes a lot of sense. You know, looking at this scenario, if you're an early career professional, like a junior accountant, you are a Murag in this situation. You're the one actively hunting down these transposition errors to fix the ledger.
Yeah, but if you're a senior professional, a manager, you use this reconciliation process differently. You use the corrected data to authorize the final $510 payment. And then you immediately call Halima to maintain that vital supplier trust.
And that right there is exactly what the examiner is testing when they ask about transposition errors and sales tax inclusion.
They want to know if you can navigate that real-world friction.
But even with a super clear example like that, there is one specific trap that trips up students on exam day all the time, isn't there?
Oh, absolutely. The biggest mistake is confusing a timing difference with an accounting error.
Okay, explain what you mean by that, because our brains really struggle with this one.
Well, let's look at the Amelia and Charles example from the sources. Amelia's internal records show she owes Charles $650.
But Charles's statement says the total owed is $750.
Right, a clean $100 difference. Now, Amelia actually sent a $100 check on September 30th to settle an invoice.
So what happens is the student's brain sees that discrepancy, the $650 versus $750, and immediately wants to fix Amelia's accounting records by adding that $100 back.
Exactly. The brain assumes that a difference means someone made a mistake. But the brain forgets to account for physical reality. The mail takes time.
Or even digital transfers. Your accounting software might process numbers at the speed of light, but the postal service definitely does not.
Right. Because Amelia already recorded the payment correctly on her end, no adjustment to her books is needed. Her books are perfect.
So it's literally just a timing difference.
Exactly. Charles will update his books when the check finally arrives.
That is such a crucial distinction. To ensure you don't fall for that cognitive trap, here is your exam day survival guide. 3 things. Here's number 1.
Identify timing differences first, before you do anything else.
Yeah.
A check in transit is a timing difference. Entering 300 as 400 is an error. Separate them immediately.
That's great. Tip number 2. Don't be fooled by partial credit notes. Like we saw with the damaged goods, remember they do not have to match the full value of the original sales invoice.
And tip number 3, sales tax is always included in the final due amount. The supplier statement will reflect the gross amount owed, which is inclusive of that tax.
So never strip the tax out when trying to reconcile the final balance.
Exactly.
So just to lock this in for everyone, reconciliations are simply your tool to bridge the gap between your internal books and the supplier's external reality.
That is the core of the whole process.
For the younger listeners tackling these exams, just follow the steps methodically, trust the process, and don't let the sheer volume of numbers overwhelm you.
And for the experienced professionals, mastering this isn't just about passing an exam. It ensures you never lose a key vendor over a totally preventable admin glitch.
Which brings us right back to where we started. You never have to blindly stare at a massive trade payables lump sum again.
Reconciling individual supplier statements is the key to protecting your business relationships and securing your exam marks by finding the hidden gaps.
It really is.
It does leave you with a fascinating thought to mull over. If we rely so heavily on external statements from our suppliers to verify our internal records, how much of our own financial data is ever truly independent?
Oh, wow. That is a fantastic point to end on. Thank you to our global audience for joining us on this deep dive. If you found this helpful, please follow us on Spotify and leave a review. We'll catch you on the next one. Thank you for listening.